When you start to see that sort of level of coverage, you realize that a peak is coming and there is going to be a correction. People got in when gold was going to beyond 5,500, was heading to the moon. People got out when gold didn't, and now people are looking at us now and saying, well, this actually did fundamentally have some good assets in it.
Mike Allen is back. He's the president and CEO of StrikePoint Gold. He was on the show a couple of months ago, link down below for the last interview in February. Back then, gold had just corrected from an all-time high. The correction hasn't really stopped, and gold is now currently trading at around $4,000. The miners are down significantly from their highs as well earlier this year. What's next? How can momentum be sustained, and what can we expect the miners to do in reaction to this downturn? Mike, welcome back to the show. Good to see you.
Good to see you.
It's been a tough quarter for the miners, given that gold has run up considerably in the last year, peaked around late January, and now both gold, the bullion, and the miners have come down considerably from their highs, with the GDX index down 35%. Still up a lot since the year ago, Mike, but people are short-term focused. And so sentiment right now is a lot weaker. Can you just tell us about how miners are reacting, first and foremost, to this downturn?
Well, I think that your point about, it's down 35% in the quarter, but up considerably over last year. You have to look at the overall picture of it, and I think that as people settle into the new reality of where we are and how profitable gold mining is, particularly in the larger, when you've got the leverage of a big producer. I think that people will start to expect it. I agree with you that the people are short-term focused, and you could see a peak developing. I was actually at home with my wife, flicking through channels on TV when gold was moving through $5,000, and it was on CNN. And those are the sorts of things when you start to see that sort of level of coverage, you realize that a peak is coming and there is going to be a correction. I think that there's an opportunity now that we're going to build a fairly solid base here at 4,000, and as the world continues to move as it is, you'll start to see things return back to where we go, with a gradual uptick in the gold price going over time.
We've talked about last time a Western catch-up in the commodity supercycle space after China's industrialization. Which commodity do you think best represents this catch-up trade?
For any industrial, it's got to be copper. That is life. Civilization is copper. It's everywhere around us. The screens that we're watching, all the data that we're being transmitted, it's all copper. It's even in things like the reflective windows and all sorts of wonderful things. Copper is society. So if we're going to have a Western catch-up, definitely copper is a very interesting place to be. Obviously, gold is in there as well, not so much as a commodity, more of a hedge, but there's also is commodity uses for gold as we get to be more electrically focused, for lack of a better term. If it's got to work, it's got to be gold, and those sorts of
What role does gold play in the modern central bank today?
I think it's a critical pillar of their foundation. The currencies are all over the show, whether it be the paper currencies or the cryptos. They're somewhat, for lack of a better term, flighty. I think that things like gold, while solid, I think is a good word to describe it. Both the physical attributes of the investment and the investment itself. I think it's a solid investment, and I think that as people balance their portfolio with growth versus risk, there is definitely an upside case for gold that can be made, but I think that the downside case for gold is somewhat limited.
At what point do gold miners start treating the current level of gold around $4,000 or anywhere around $4,000 as a new permanent rather than a temporary price level, given how far gold's run from just a year ago?
That's actually a really interesting question. I took in a talk recently, and the
Hmm.
CEO of Newmont was the keynote presenter, and somebody asked that.
Yeah.
And her thought was, this is the new reality. So going forward from here, essentially, what you can do with it, and you can see how some of the companies are reacting. Resources are getting expanded, reserves are getting expanded, and it's simply a function of putting a larger gold price into their assumptions. And the resources get larger. The pit shells or the stripping that can be sustained to make something economic becomes a lot higher. And so I think that you're going to see that resource expansion as people put in that, and they should start doing it now because that is the reality, and we need to start planning for it.
What do we need to see in the economy or in the gold landscape to solidify this view that $4,000 is the new reality, basically, to confirm this, and for banks and companies like yourself to start using 3,000 or even 4,000 as a PEA assumption here? I've been talking to some miners, and people are still using 3,000, for example,
Yeah.
for their models.
Well, I mean, the basic answer to that is time. The
Hmm.
longer that a lot of studies will use a 3-year trailing average as their go forward look. They'll sort of flick themselves around, and so mathematically, it's just time at at this level, and that time equals comfort, and the more that you see. Gold at 4,000, the more used to you're seeing it at gold at 4,000. I actually true story. I can remember in my career that gold was at 250,
Wow.
250. Yeah, exactly. I'm an old guy. Um,
That's not what I meant by the wow, but
yeah,
yes,
well,
gold went up a lot.
that's where it
Yes,
came on. And you open up Kitco or whatever your
sure.
preferred way of looking at gold today is, and gold is down $100, and you're like, oh my God, it's the end of the world. And then no, it's not actually. That's whatever it is, 4/10 of a percent versus the price of where we are now. And you sort of have to readjust your mind and your thinking to what the current level is. Gold's down $100, gold's up $100 at 250 an ounce. That's a big swing. That's 30% or whatever that number is. At 4,000, it's really just chop. And so you start to look at more, I would say, long-term trends than the noise of a day-to-day movement in the gold price. And I think
Do
that
you,
the long-term trend is still up and to the right.
why do you think the seniors were re-rated so much from their highs? Like Agnico Eagle, for example, just to use an example, down 44% from its top, even though the producers are still producing at much higher free cash flow margin than they were a year ago or 2 years ago. And so I wonder if you think this re-rating is fair.
Um, I think that there's a certain amount of probably we got out over our skis at 5,000,
Yeah.
and everybody, like, well, and it wasn't, remember, it wasn't 5,000, it was 5,500. It's going to go to six, it's going to go to 10. And you saw, with probably people that didn't really understand what a fundamental shift had happened in the gold price, pile in retail, for lack of a better term. Ma and Pa, see the interview on CNN and say, gold is going to the moon. I'm going to pile in, and then when gold doesn't go to the moon, they panic out, and that's just a function of the capital markets that we see.
Yeah. Well, going to the juniors now, individual company news have been a bigger driver for the
Yes.
stock price for a lot of companies
Yeah.
than the market itself. Your company being a significant point. So here,
Yeah.
StrikePoint Gold is the bar chart, and the gold price is the blue line. So here's a case in point to exercise to illustrate what I said earlier. The company is up 50%. 63% since the beginning of July, which is 2.5 weeks ago. What happened?
You know what? I think that we got ourselves oversold with the gold price move. This is, again, what we're saying. People got in when gold was going to beyond 5,500, was heading to the moon. People got out when gold didn't, and now people are looking at us now and saying, well, this actually did fundamentally have some good assets in it, and was a good company, and now you're seeing this pendulum swinging the other way.
Oversold. I mean, it did follow the price of gold. Yeah, the company's down 56% since
Yep.
March to its trough, and then it recovered very quickly after 60%. But importantly, the gold price didn't move up while
Yeah,
your
and I
stock
think
price recovered.
that
Yeah,
it's just a momentum. Like we got
I see.
pushed too far down, and now we're starting to get back towards, where we should be, and people are looking at things like our Hercules Gold asset,
Hmm.
and where we're going with it, and realizing that, what you guys are doing there, have has said, this is a good time to this is a good entry point for people.
So recent drill results probably contributed. Tell us about what happened here.
Yeah, I mean, we put out the final batch of results here for our Hercules Gold project, and it was a dozen holes that we got. And the main point of what came out of the drilling that we're doing is we've now got the data to head towards a resource estimate. The holes that came out today, the headline hole is hole five, and it's 67 meters and 6706, a point 0.3 zero point 0.3 grams per ton gold with 11 grams per ton silver. And there's a nice bit of high grade in there as well. A few meters of about 3 grams gold in it. And I think it just shows what we're seeing is, as you execute, put proper numbers out, do the work, you're going to be rewarded in the stock. And I think that there was a time there where we were waiting for the data to come out, where we may have gotten oversold. People are waiting for results, and as you said earlier, people are short term. They get bored and they move on to the next shiny thing. And we got oversold, and now we're moving our way back with the news, and then the upcoming news of what we're going to be putting out, which is we're heading towards a resource estimate sometime in Q4 this year.
Have explorers like yourself spent more money on drilling, given the run up in gold price in the last 2 quarters? In
A
other words,
hundred
has
percent.
above 4,000, a lot of deposits seem more economic
Yep.
than maybe when they were at 2,000, and so there's a higher economic incentive for you to start spending more money on drilling. Does that make sense?
It totally is. And I mean, like the economics of it. I mean, using gross numbers, half gram per ton material, 200-ton haul truck. There's about at $4,000 an ounce gold. There's about $12,000 in the truck. Obviously, at 2,000, it was half that much, and so you have to imagine that, these low grade big things that, like the Hercules Gold project, are very much levered to the gold price. Every truck that comes out of the pit with ore in it, or mineralization, don't know if we can say ore, in a mine, has a huge leverage on it, and that's why you're seeing the seniors. It's not just a truck that matters; it's every day the thousands of trucks that they have over multiple operations. That's massive leverage. The juniors, to your question, you can see what could become. You have projects like Hercules or other projects where that's going to be a fairly significant mine. Not saying that Hercules is, but at some point, people are saying that there's the potential that can be a very significant mine in the future, and so people are starting to get in. But also, to your question about, people drilling more when there's when good gold prices are there, 100%, and you see that in rig availability, competition for geos, all the things, the supply chain that you need to execute a drill program tightens.
Are there any, I guess, different kinds of challenges that come up when the gold price is higher, when you start drilling at 5,000 or $4,000 gold versus $2,000 gold?
I mean, you can call it supply chain,
Okay.
and I would call it, the geologically or the mining specific supply chain. The single biggest influence on the success of a drill program is the people, in my opinion. If you get good drillers, good geos, good drillers to get the hole down, good geos to know when to stop or when to extend a hole. That's the influence of success. When
Mhm.
you have a high gold price and a high stock price, you get a lot of competition for people and equipment, rigs, geos, and drillers, and so the quality of everything goes down, particularly in a bull, and you'll see a correction, and you'll see poor product put out there.
If you take a look at the latest drilling result
Yeah.
that you put out, have you and your team noticed anything underground that has changed the way you look at your current geological model?
The biggest thing that has happened over the last 2 years with Hercules is we have identified a zone on the southwest corner of what we call the Cliffs target, and we've touched it in about 5 different holes over 2 programs. There's a quite large zone of disseminated material that's relatively close to surface. We've touched it in I think 5 or 6 holes over the last 2 years, and it consistently gives thick, you know, 60 to 100 plus meter intercepts of good gold grades with a consistent silver sweetener. The thing that is interesting about that is we always seem to be on it always seems to be expanding whenever we try and push it further to the south. We continue to hit it. So it is something that we're excited about, and we'll be following up as we go forward with the company
Yeah.
is moving further to the south.
People should check out our first interview with Mike, link down below, where he outlines StrikePoint Gold's projects in more detail, and he provided a thorough overview for a first-time viewer and follower of StrikePoint Gold. Here I have on my screen, Mike, a website, strikepointgold.com, showing the topography, not the topography, the map of Hercules Gold Project situated in Nevada. Tell us about the jurisdiction itself and what's unique about Hercules.
Well, I mean, Nevada, just on the basics, is Nevada is arguably the number one mining jurisdiction in the world. It generally rotates between Nevada, Quebec, and Finland. It is probably the two things that make Nevada unique, and all probably the top three are unique, is the geological endowment. Nevada, without getting a whole bunch of geology, is very unique in what the geology has been done to it over the past, and that makes for significant gold deposits. That feeds into the regulators and the social fabric of Nevada. People know mining. If they're not working in the mining industry, their dad, their uncle, their whatever it is, their cousins are working in the industry, and there's a comfort level for the people on the street that they understand what it is. And it's when you drive around in Nevada, it's very obvious that this is a mining area. There are old mines everywhere. There are producing mines everywhere. I did a drive up to look at our Cooperite Gold project relatively recently, and at the end of the day, I got out a cocktail napkin and totaled up the amount of gold that I drove by, and it's an astronomical number. It's millions and millions and millions of ounces that you drive by, and this is just on the paved highways you're driving up from Vegas up towards Cooperite. So it's a very unique place with a long history and a bright future of mining.
When you say that the geology, the uniqueness of the geology has reached the regulators, what does that mean? What have the regulators in Nevada done that's different from regulators of another jurisdiction, let's say?
I would say that it's the comfort level. They have permitted multiple mines over the history, and they continue to permit mines. And so they're always fresh, they're always current, they know what mining is, and so that mining culture is into the regulatory culture there.
What about the infrastructure of Nevada? Is it developed?
I mean, it's world class. It's lower 48. obviously USA. So there are remote places in Nevada. You can still find yourself in the middle of nowhere, but you usually drove on a paved road to get there.
Hmm.
And so I like to make a comparison. I used to work on a job up in the Arctic, um, and I was sitting down with a colleague at one point in time, and we're looking at a can of Coke, and how much does that can of Coke cost to get to site?
Yeah.
And it's you do the math out. This was in the year 2000 when a can of Coke cost a dollar. You buy it in the store in Yellowknife. You put it on a plane. You fly it to site. You pay the guy to handle it. You pay the plane, all that stuff, and you get it to site. And that can of Coke costs $7. Is what it cost the company. Just sitting there drinking it in the cafeteria. Versus Nevada, you fly into Las Vegas, you get in a rental truck, and if you want a can of Coke or lots of them, you go over to Costco and they're pick a number, 12 cents each or whatever that number is, 23 cents each. You throw it in the back of the truck and away you go. And so the infrastructure is world class. There's power, there's water, there's people. The other part of it is really that people infrastructure. People know mining. They know how to run the big gear and make efficient operations. So it's the power of the American worker is very pronounced. There's the force multiplier of the big gear and the people that know how to run it.
Yeah. Tell us about Anglo Gold's Arthur Gold project in Nevada,
World
and
class
how
discovery.
that's changed investor perception of discoveries in that region.
Well, there's a how much time have we got? I mean, the Arthur Gold discovery changed the Walker Lane, and I've got my part of that. I used to have a company called Northern Empire, and we were on the southern edge of Arthur, and we got that asset. We bought it for $10 million, and 16 months later, we sold it to Core Mining for $120 million. Made money for shareholders on all accounts. Um, we didn't hit. We didn't take all the money off the table. Core turned around and sold it to Anglo Gold a few years later. I think that they got 200 or $230 million for it. That's all been consolidated into the Arthur Gold project. There is a massive discovery that's going on near Beatty, Nevada, and I believe that the current numbers right now are 13 million ounces discovered on two deposits, Silicon and Merlin, and then they've consolidated the entire area around them. And I think that the number from all the consolidation efforts is north of 20 million ounces. Truly world-class district, and the discoveries are new. It's not a retread of an old discovery. It's a pure scientific, this should be here, so we're going to drill a hole, and it worked. And it worked exceptionally well. World-class deposit there. And that is actually an interesting thing in a mature camp like Nevada, is that you can make these new discoveries. You got to do the science, you've got to do the work on it, but it continues to put up world-class numbers, world-class deposits in something, in an area that has seen probably 150 years of mining and all the mining, the modern work that goes into it.
Okay. There's been some talk that Yukon has experienced or could experience labor shortages given how low the unemployment rate is in
Yeah,
Yukon. I'm just using that as an example for.
yeah,
And if you take a look at Nevada, do you think similar labor shortages could be in effect?
definitely. I mean, you see that in what I was talking about earlier, getting drill contractors. It's very difficult to get rigs right now. And I think that skilled work, particularly, is skilled labor is going to become uh, more difficult to find. I mean, it's not a common thing to have on your resume. I know how to drive a 300-ton haul truck, or I know how to work a diamond drill. These are specialized skills, not really exposed, and there's a learning curve to getting experience with that, and it's tough with
Hmm.
our industry and the cyclicalness of it. to get people to commit careers to it.
Yeah. Last time we spoke about peak gold, um, which is a concept that was, I guess, first formulated when the price of gold was much higher. Do you think at $5,000 gold or even above $4,000, we could push the timeline of peak gold, which is the peak production, or rate of production of gold peaking around the world out
Oh,
further?
well, I mean, what makes ore is a function of price. And if you increase price, then you increase ore. It's direct drive. Um, and so definitely if you increase the gold price, you will make more gold and you will make more ore and you will push out the peak of production to some point else. You're going to be obviously mining lower grades, and so there's a consequence to that. But I think that you also see the interest, as we talked about earlier, interest in funding exploration to make more significant discoveries. And I think that the Arthur Gold Project is a prime example. World-class discoveries are still out there to be made, even in mature districts like Nevada, and definitely in places that don't have the infrastructure or the mining history that Nevada does.
A lot of exploration models were built on much lower gold prices. Now that gold has stabilized above 3,000, arguably even above 4,000, how has this new price regime, if you want to call it, changed the way you evaluate projects, how you allocate capital, which ounces are worth pursuing, and so on?
Well, that's actually a really interesting question because you have to look at your all the assets that you discarded
Yeah.
at 2,000 or 1,500 or whatever gold price you had and give
hmm
them another view at 3,500, and the changes can be shocking. Um, I mean, just do simple math. The Pan mine in Nevada, it's a small producer. It does about 30,000 ounces a year. And I think for the sake of the argument, let's call their all-in sustaining cost $2,000. At 2,000 bucks, it's breaking even, at every $100 that it goes up. The profitability goes up 30,000 times 100, 3 million bucks a year. You throw in 3,500 or 3,000 or 4,000, that's a lot of dough. And so it definitely changes your perception of assets. At a small producer at that is near break even prices barely gets attention, but a small producer that is wildly profitable, a couple of $1,000 an ounce, that's interesting, even if it is because the multiplier is so much.
So finally, the biggest change in the gold market today versus February when we spoke for the
Yeah.
first time is, as we've talked about in the beginning of the interview, the decline of the gold price and the weakening sentiment. Now, $4,000 gold today is a very different environment sentiment-wise than $4,000 gold last year when
Yeah.
gold was on an uptrend. Have you noticed people, investors in particular, being a little more cautious at $4,000 gold today than when it first reached $4,000 last year? And how would you explain this situation to the same investor who is a lot more cautious today at the same price than last year when gold first hit that price?
Well, I think that you have to, as an investor, you have to mind the momentum, and which way is the tide going. And so when gold surged through $4,000 an ounce, obviously it was on an upswing, and then it ebbed back to it went to 5,500 high tide for lack of a better term, and then it ebbed itself back to 4,000. And I think that the overall um, chart is that gold is still on a long-term up cycle. I think that you have to be mindful of the day-to-day chop, and just say, okay, if your thesis is that gold is going to go to 5,500, run with it. Obviously, monitor the conditions that you're operating under. But if that's the case, I think it's a good bet. And then you just have to watch yourself from falling away from your original thesis and being washed out when there's a short term movement. I think that there's, like I said, the overall chart looks pretty good. We do have a recent pullback, which is an opportunity for people to evaluate their thesis and then either create liquidity or reload and go from there.
Okay, good. Well, congrats on the latest drill results. Tell us about the next catalyst or major milestone that we have to watch
The
for.
big milestone that's going to be coming out is we're going to take all the data, get together with the QP and start working our way towards a resource estimate, and we're expecting that to come out Q4 of this year.
Okay. And just for investors who may be new to the mining space, walk us through the timeline of an entire mine's life. So what happens after a resource estimate is made?
Yeah, then you get into more. So the resource estimate is the first of is the first of the significant technical studies. You actually have a defined resource in the ground, and then you can start to do things with the resource. You can start to increase the confidence. We're heading towards an initial resource estimate, and we expect most of the ounces to be inferred. You upgrade the confidence of them, and then you also start to apply economics to them. What would it cost to get it out? What would the pit look like? The strip ratios, metallurgy, those sorts of things. And then you start coming up with PEAs and more detailed studies until you finally have a feasibility study and then a construction plan. And there's obviously permits are running a parallel path to that in the background.
How much of a company's value at any given time should be based on inferred rather than indicated resources?
It depends on the company. I mean, a company like, let's pick a senior gold producer, Barrick,
Sure.
wouldn't put a lot of value internally in their inferred resources because they are speculative. There's no guarantee that they're going to ever be economic or converted or upgraded. A company like StrikePoint, which is a much smaller market cap company, there's a risk profile associated with inferred, but it can be, we're also a much less of a market cap or even dollars per share than a Barrick. So I think that it depends on the company, and you can see valuations that are decent based on inferred resources. It's it's the start, and then you have to judge the quality of the data, or the market judges the quality of the data and tells how much we want to be a part of this.
Do you expect M&A activity to pick up or decline at $4,000 gold versus $5,000 just a few months ago?
I would say that it's probably there was a time there at 5,000 that things were overdone, out over your skis, however you want to put that expression. And I think that the pullback has probably created some relative bargains. There's an opportunity if there was M&A and we can't quite settle on the price because everybody's run up. And now everybody's settled down, and you can sort of see how companies moved relatively to each other. So you could see another wave of M&A because the effort to define an ounce of gold or define a mine versus to buy a mine, it's a completely different thing.
You would think M&A picks up when the gold price drops. Why doesn't it?
Because for acquirers, their share price is down, and so they don't want to be diluting at this point.
I see.
Yeah.
Yeah. Okay, good points.
Yeah, a strong producer in this environment should be picking off weak producers with good projects. The corp dev department should be very active right now, but everybody, you have to also, be mindful of the CEO's dilemma of do I want to dilute at this price?
I guess if you were to make a case for the shareholders, long term it would be accretive, maybe short term dilutive. Would that make sense?
It would be, yeah.
Yeah. Okay. Thank you so much, Mike. Congrats again on the latest results. Tell us where we can follow the company to stay up to date on news.
Gold.com is the website, and there's all sorts of videos and and data up there for people to take a look at.
All right. Appreciate it, Mike.
No
Take
worries.
care,
Thank
and
you
we'll
very
speak
much,
again
Steve.
soon. Thank you for watching. Don't forget to like, subscribe.